Hello, and welcome to the latest Structured Finance and Focus podcast. I'm Ian Rasmussen, Managing Director and Co-Head of Fitch's Asset-Backed Securities Rating Group. I'm very excited to be here with Kohl and Mike Girard. They're both senior directors in the group, and they're sector leads for unsecured consumer loans and auto loans, which we'll spend some time talking about today. To begin with, I wanted to spend a little bit of time, kind of a catch up within those two sectors, and where we're at from a performance standpoint. And then we'll get into the macro backdrop that's changing slightly and spend our time talking a bit about unemployment and the jobs outlook for next year and the impact on ABS. Harry, starting off with unsecured consumer loans, can you give an update on performance, maybe comparing where we're at now to 12 months ago?
Thanks, Ian. A year ago, we were at the end of a long period of increased delinquencies and defaults, dating back to mid-2021, when the last of the COVID pandemic-era government stimulus ended. Originators ramped up origination in open credit boxes due to improving economic conditions, but inflation taking hold and depletion of obligors' balance sheets led to this deterioration in performance. Utilizing DV01's consumer unsecured benchmark managed UCL loan data, CDRs increased from 3% in mid-2021 to 12% by the end of 2023. Originators responded by tightened underwriting and cutting originations. Early in 2024, these actions finally led to stability in performance, and performance has remained stable through 2024, although at levels still higher than what was seen pre-COVID. So compared to 1 year ago, while delinquencies and defaults remain elevated, we're in a period of stability after originator tightening took hold.
Thanks, Harry. And you mentioned originator tightening, kind of that credit box tightening. Could you give a little bit more color on what you've been seeing there and how that's led to stability?
Of course. Although there were cuts to origination volume across the board, the biggest target of cuts were near-prime obligors and those on the margins of obligors credit boxes. Utilizing the same DV01 dataset, originations fell from a peak of $4.4 billion in May 2022 to a low of $1.9 billion in December 2023. Originations to borrowers with less than a 700 FICO score fell even more dramatically, from $2.3 billion in March 2022 to just $500 million in December 2023.
Thanks, Harry. And Mike, let's bring you into the discussion because we've also seen some weakness, particularly in subprime auto. Have you observed credit tightening there as well? Could you talk about an update to what we're seeing in terms of performance?
Sure. Thanks, Ian. So similar to the tightening within UCL that Harry just mentioned, we've seen similar measures within subprime auto, which include tightening around weaker FICO and loan-to-value bands, which were put in place by many loan originators after seeing deterioration in performance, especially within the 2022 and 2023 vintages, which were originated when vehicle prices were at peak levels and financing rates were high. Following that implementation, though, what we've seen is that performance of the late 2023 and the 2024 vintages have actually been outperforming the 2022 ones, but still we're seeing that relative weakness when we look at it on a comparative basis to pre-pandemic vintages. Majority of this weakness, though, is still related to the macro pressures on these weaker borrowers, so higher inflation, higher rates, now compounded by a slowing labor market rather than the impact from falling used vehicle prices. And if we look back for a second, with these borrowers, they received substantial amount of help during the pandemic, so high government stimulus measures and loan relief, which ultimately led to some FICO inflation and improved finances. Looking at more recent now, though, these support measures are gone and many have drawn down on their savings, and pressures have just continued to build as they face these macro pressures impacting real wages and overall their ability to service debt. Now, that's something we've been seeing recently, especially when we look at the impact from tax season. Typically, the seasonal impact has a larger impact on delinquencies, bring them down, but it hasn't had as large of an impact compared to prior years. We've also seen these pressures within our delinquency index for subprime auto. So the Fitch 60-plus day delinquency index has now surpassed its prior record high. We haven't yet seen this transition to net losses at the same rate, so there's a bit of a lagged effect there, and that's really due to a bit of delinquency churn, so many borrowers are just tending to float within the delinquency buckets, eventually making a payment and preventing them from defaulting.
Yeah, thanks, Mike. But that doesn't tell the whole story, does it? It's not just macro pressures that have contributed to, for instance, the rise in that delinquency performance that we're seeing within the subprime index.
Yeah, that's correct. So if we look at the index overall, there has been a composition change there, which has led to some of the deteriorating credit metrics. So it's part of that composition change as well as the impact from used vehicle values on recoveries. So if we take a look at the composition part, so we've seen overall growth in the number of platforms, which is a result of sustained strong demand for used vehicles over the last few years, leading to several newer and smaller lenders entering this space. And these lenders typically operate within the deeper subprime part of the market, which tend to have weaker performance compared to the longer or more established lenders in that market. So typically you just see weaker performance there. The other impact on performance is from recoveries, which in subprime auto ABS, these have weakened to below their 2019 levels, which is driven due to that softening used vehicle market. But we're seeing a larger impact on the subprime space more so than in prime, and that's really due to the relative age of the vehicles. So we're seeing a larger impact on declining values for older vehicles rather than the 2 to 4 year old vehicles you typically see in prime. Compounding that is just the pressure on these borrowers who typically will purchase those older vehicles, and they're having a bit of an affordability issue there. Making things a bit worse here is the repossession leg, just given the shortage we've seen in the industry overall. And that has just had a dampening effect on the overall recovery performance as defaults have been increasing.
Yeah, great, Mike. And Harry, both of you, that's a great update. And so let's shift, I guess, just as the Fed recently did in their fight against inflation, lowered interest rates by 50 basis points. We've been watching unemployment ever since the pandemic, but this has been an area of strength really within the economy. Mike, could you talk a little bit about Fitch's expectations for the job market next year?
Sure. Thanks, Ian. So far, we've seen a slowing economy, but it's been a bit stronger than we expected. Unemployment has been steadily increasing from a low of 3.5% in April 2023, rising to 4.2% in August. But that's still relatively strong by historical standards. So while the labor market has been cooling, it remains pretty tight and resembles more of a balanced market. Now, looking forward to next year, we're expecting the cooling of the labor market to continue, but to more of a softer or lesser degree as unemployment rises to 4.9% and wage growth continues to decelerate, which will ultimately impact consumer spending as household income declines. However, we're still expecting the underlying strengths in that market to remain, just given where many of those metrics are compared to the long-term historical average. And one point here is the unemployment. I mentioned it's 4.9% currently. The 12-year median rate is 5.1, so relatively pretty strong. And while there is some focus or a lot of focus on the SOM rule being triggered, which typically has been a reliable signal for a potential recession in the U.S., it's important to note here that the large increases in employment have historically been due mostly to layoffs. Currently, the layoff rate is at its lowest level in 20 years, and the main driver for unemployment has actually been from the growth in the labor force driven by large population growth from immigration and those coming back to the market looking for work. That coinciding with companies that have slowed hiring, in which the hiring rate has trended down to 3.3%, which is about 0.5% below the 2019 levels. So permanent job losses so far have only really accounted for around 20% in the growth of unemployment. But with the labor market fully balanced now, we're expecting further weakness in the labor demand will result in slack in the labor market, typical of what we saw prior to 2018, though overall we're not expecting to see a large shock at this point.
All right, good. So no large shock to the labor market at this point. It's the expectation. But there are some consumer segments that will be pressured by the conditions we're expecting. What does this mean for ABS performance next year, Mike?
So certainly there are pockets of weakness within the consumer. Mainly that's the younger and the subprime borrowers, which have continued to feel more of the pressures from inflation and higher rates. This has been compounded as more younger workers have really struggled to find work, with those aged between 16 and 24 years having seen much quicker pace of growth in unemployment relative to the other cohorts, with an unemployment rate for that group up 300 basis points to 9.1% in August from a lower point in April 2023. This compares to an overall increase during that same period of about 80 basis points for the total unemployment. So not only are they seeing more pressure due to the inability to find work in a market where employers are pulling back on hiring, they've also just accumulated less savings and experienced less wage growth compared to the other age groups. And overall, this has a direct impact on their ability to service debt. we're already seeing some of this pressure from that age group within credit card and auto loan delinquency trends, with more loans overall transitioning to serious delinquency, more so than what we saw in 2019, and mainly driven by these younger borrowers. These trends are also present within ABS. However, I'd like to point out the benefits of securitization overall, which typically include eligibility criteria, which includes seasoning of accounts and minimum borrower credit scores, which usually results in stronger performance of the pools compared to the overall loans in the market. And just looking forward, as I mentioned, we're not expecting a shocking increase in the unemployment rate for next year. So in terms of ABS performance, we're expecting to see a similar moderation in performance that we saw this year. However, just bringing it back to what I said about the younger borrowers, for those trusts that have, or pools of collateral that have a higher concentration with those borrowers are new to credit, we'd expect to see further deterioration there, all else equal.
Great, thanks, Mike. Now, Harry, as you mentioned before, inflation really had an impact within the UCL sector. And we still know that inflation's higher, rates are higher for a bit longer. How are these pressures going to manifest within ABS next year, maybe talking specifically within the UCL space?
Thanks, Ian. As the economy picked up steam in early 2021 as pandemic-related restrictions relaxed, the year-over-year increase in real disposable income hit almost 35%. This exuberance contributed to the increases in UCL loan origination, but inflation quickly began to take hold. This positive growth in real disposable income soon reversed, and the year-over-year change in real disposable income reached a low of nearly negative 25% in early 2022. And year-over-year change in real disposable income would remain negative until January 2023. This decline in real income also shifted the amount of excess savings to negative territory, where it still remains. These negative economic headwinds forced many obligors to make choices after previously accumulated excess savings were depleted. Delinquency and default deterioration was first evident in unsecured consumer loans in 2021 and into 2022, then subprime auto around a year later, and then flowed to other consumer segments. The deterioration of unsecured consumer loans first before other sectors shows the impact of payment priority by obligors. Unsecured consumer loans have inflexible payment schedules and provide no ongoing utility after origination, so are likely to be the first loans obligors choose not to pay in periods of economic hardship. Despite these negative trends, the reevaluation and tightening of credit by UCL originators bodes well for future performance outside of unforeseen severe shocks.
Yeah, great, Harry. So certainly real wage growth is something that we're going to be watching in addition to unemployment as we move forward. Mike, to finish off, we recently published an update to our consumer health monitor. And I think one of the key sources of strength remains to be kind of household balance sheets. And just wanted to maybe wrap up with talking about how that comes into our thinking for ABS performance next year.
Thanks, Ian. So our base expectation is that consumer spending slows through next year and labor markets continue to soften, which include rising unemployment and slower wage growth, as I mentioned. However, there is a possibility, as you mentioned, of stronger than expected loan performance should consumers continue to utilize their remaining accumulated savings and gains in wealth to help maintain their debt if they should reach a point where they have trouble making payments, which could be a result of a job loss, for instance, which overall those mitigants could help prevent a significant increase in default frequency for loans. But there are a couple of things to note here to speak on when we think of the relative financial health of the consumer is that while debt levels have increased off lower levels seen during the pandemic, household leverage as a percentage of disposable income is marginally lower than the pre-pandemic levels. Similarly, debt service levels have only modestly increased during this high interest environment time, which is mainly attributed to many mortgages being refinanced at the low point of the interest rate cycle and mortgage originations having slowed while incomes have continued to increase. This, in addition to the growth in wealth that we've seen, should help. However, as we know, gains in overall wealth have not equally been distributed, with the higher income households benefiting more, especially from equity and real estate markets, and therefore hold more cushion against stress events. And with that, we'd expect potential upward surprises would likely be driven by these more wealthy households.
Great. Thank you, Mike. And I want to thank both you and Harry for your insights. And I want to thank all of you for listening. For more information on ABS performance and to stay abreast of the strong ABS issuance activity that we're expecting through the end of this year and into next year, we hope that you'll visit our website, fitchratings.com. Thank you.